The world of investing is often associated with large sums of money, but the notion that investing requires substantial capital is outdated. In recent years, technological advancements and the rise of micro-investing platforms have made it easier for individuals to start investing with small amounts of money. However, many people wonder whether investing in small amounts is truly worthwhile. In this video, we'll explore the pros and cons of investing small amounts and whether it's a viable strategy for building wealth. Let's look at the pros of investing small amounts. Accessibility. One of the primary benefits of investing small amounts is accessibility. Micro-investing platforms and apps allow individuals to start investing with minimal capital. This accessibility lowers the barriers to entry and enables people from all walks of life to participate in the financial markets. Dollar cost averaging. Investing through a dollar cost averaging strategy can help mitigate the impact of market volatility. By investing fixed amounts at regular intervals, investors automatically buy more shares when prices are low and fewer shares when prices are high. Over time, this disciplined approach can result in a lower average cost per share and potentially higher returns. Compound interest. Even small amounts of money have the potential to grow significantly over time thanks to the power of compound interest. The earlier you start investing, the more time your money has to compound, magnifying the impact of even modest contributions. Learning experience. Investing small amounts provides an opportunity for individuals to gain hands-on experience, learning valuable lessons about asset allocation, risk management, and market behavior without risking large sums of money. These lessons can serve as a foundation for making informed investment decisions as their portfolios grow over time. Now let's look at the cons of investing small amounts. Limited impact. Investing small amounts may yield limited returns, especially in the early stages. While the growth potential exists, the absolute dollar gains from small investments may be relatively modest compared to larger investment amounts. Thus, it may take longer to see significant progress towards desired financial goals. Diversification constraints. Diversification can be challenging to achieve with small investment amounts. Purchasing a diversified portfolio of individual stocks or funds may require substantial capital, making it difficult to spread risk across different asset classes and industries effectively. Market volatility. Investing small amounts may expose investors to the full brunt of market volatility, particularly if their portfolios are not adequately diversified. While dollar cost averaging can help smooth out short-term fluctuations, prolonged market downturns can still erode the value of small investments, potentially leading to discouragement or premature withdrawals. Overall, investing small amounts of money is not only feasible, but also a crucial step forward building financial security and wealth over time. By starting early and being consistent, even modest investments can grow substantially and help you achieve your long-term financial objectives. However, investors need to be aware of the limitations associated with investing small amounts, such as transaction costs, diversification constraints, and market volatility. Ultimately, the decision to invest small amounts depends on individual circumstances, risk tolerance, and investment objectives. Make sure you subscribe to XTB to learn more about trading and investing.